In a court of law, witness testimony is considered the weakest form of evidence. It is subjective, it is fallible, it is colored by perception, memory, and the unconscious biases that distort every human observation. The strongest evidence, the evidence that wins cases, that overturns doubt, that produces verdicts beyond reasonable question, is physical, forensic, documented, measurable, the kind of evidence that exists independent of what anyone thinks, feels, or remembers. I am going to present you with forensic evidence today, not testimony, not opinion, not "this worked for me and I think it might work for you" evidence, the kind that survives cross-examination. The kind that stands up not because I say it does, but because the mathematics, the market mechanics, and the structural logic behind the pattern make its reliability inevitable rather than incidental. This pattern has never failed me, not once. I want to be precise about what that means, because the claim deserves precision. It does not mean every trade based on this pattern has been a winner. Trading is probabilistic. Losses are inevitable, expected, and statistically necessary in any system with a genuine edge. A loss is not a failure of the pattern. A loss is the cost of participation in a probabilistic process. What it means is this: every time this pattern appeared in its complete, unambiguous form, with every element present, every condition satisfied, every structural requirement met, the subsequent price move was in the direction the pattern indicated. Not most times. Every time. And when you understand why, when you understand the market mechanics that make this pattern's reliability not a coincidence but an inevitability, you will understand why never failed is not a boast. It is simply a description of physics. Before the pattern, the framework that makes it work. You cannot understand the pattern without first understanding the framework in which it operates. The framework is market structure, not indicators, not oscillators, not any derived lagging representation of price, the raw, unfiltered sequence of highs and lows that price creates as it moves through time, the structural record of every battle between buyers and sellers, written directly on the chart in the only language that cannot be manipulated or misinterpreted. Market structure tells you one thing, the only thing that actually matters before entering any trade. Who is in control right now? In an uptrend, a sequence of higher highs and higher lows, buyers are in control. They are winning every battle. Each pullback fails to reach the previous low. Each rally exceeds the previous high. The structural record is unambiguous. Demand is overwhelming supply. In a downtrend, lower highs and lower lows, sellers are in control. Each rally fails to reach the previous high. Each decline exceeds the previous low. Supply is overwhelming demand. In a range, equal highs and equal lows, neither side is decisively winning. The battles are drawn. Price oscillates between the same levels, unable to break decisively in either direction. The pattern I am about to reveal operates exclusively within the context of an established trend. It is not a reversal pattern. It is not a range trading setup. It is a continuation pattern, one that identifies with forensic precision the exact moment when a trend's temporary pause has ended and the original directional pressure is resuming. This is why it works. Not because of technical analysis magic, because it identifies a specific structurally defined moment in the relationship between buyers and sellers, a moment when one side has definitively reasserted control after a period of contest. That moment, identified correctly, is as close to a certainty as the probabilistic world of trading allows. The pattern, complete forensic description. The pattern is called the trend continuation pullback reversal, and while the name sounds technical, the visual is one of the cleanest, most intuitive formations on any chart. Here is the complete forensic description. Every element documented, every condition specified, every requirement defined. Element 1, the established trend. The trend must be clearly established on the daily chart before the pattern is valid. Not a 2-week-old trend, not a developing trend that requires optimistic interpretation to classify as such. An established trend, one with a minimum of 5 clearly identified swing points, for an uptrend at least 3 higher highs and 3 higher lows, demonstrating that the directional pressure is real, sustained, and not a temporary fluctuation within a larger opposing move. This requirement eliminates one of the most common and most costly trading mistakes, entering continuation patterns in what turn out to be counter-trend moves within a larger opposing trend. By requiring a minimum number of swing points on the daily chart, this element ensures that the trend you are trading is the dominant trend, not a temporary retracement within a higher time frame downtrend. Before identifying any other element of the pattern, this question must be answered definitively. Is there an established multi-swing point daily trend? If the answer is no, or if the answer is uncertain, the pattern does not exist. Stop here and find a different instrument. Element 2. The impulse move. Within the established trend, price must have recently produced a strong, high-momentum directional move, an impulse in the direction of the trend. This impulse is visually distinctive. On the daily chart, it presents as a series of large-bodied candles, all in the same direction, with minimal overlap between adjacent candles. The momentum is unmistakable, not a gentle grinding advance, but a decisive high-energy thrust that creates a significant distance between where price is now and where it was before the impulse began. The impulse is important for two reasons. First, it confirms that the trend remains active and energetic. A trend that has lost its ability to produce strong impulse moves is a trend in the process of exhausting itself. A trend that is still generating high momentum directional thrusts is a trend with institutional backing and sustained directional pressure. Second, the height and velocity of the impulse determines the scale of the pullback that follows, and the scale of the continuation move that the pattern identifies. Strong impulses are followed by deeper pullbacks and larger continuation moves. Understanding this relationship allows for the anticipation of both the entry opportunity and the profit target. Element 3. The corrective pullback. After every impulse, price corrects. This is not optional, this is structural. As inevitable as an exhale following an inhale, the correction serves a function that most traders never fully appreciate. It allows institutional participants, the traders deploying capital in volumes large enough to move markets, to complete their position building at prices more favorable than the impulse's high. During the impulse, institutions drive price in the trend direction with aggressive buying in an uptrend. During the correction, they continue accumulating more quietly, more gradually, as price retreats to lower levels. This accumulation during the correction is what fuels the next impulse. Understanding this, the correction in an uptrend is not a threat. It is not evidence of trend failure. It is the preparation phase for the next leg higher. The corrective pullback has specific structural characteristics that distinguish it from a genuine trend reversal. It moves counter to the trend direction, downward in an uptrend, but with less momentum than the preceding impulse. The candles during the correction are smaller, less decisive, more mixed in direction. The energy is clearly lower than the energy of the impulse. It does not break below the most recent higher low established before the impulse began. This is critical. If the correction breaks below the previous higher low on a daily closing basis, the structural integrity of the uptrend has been compromised. The pattern is invalid. Step aside. It retraces a portion, typically 38% to 62%, of the impulse move before the counter-trend energy is exhausted. Element 4. The internal structure shift. This is the most sophisticated element of the pattern, and the one that most clearly distinguishes it from simpler, less reliable pullback trading approaches. Within the corrective pullback, price creates its own internal structure, a series of lower highs and lower lows that form as the counter-trend move progresses. Watch carefully as this internal structure develops. At some point, typically after the correction has retraced between 38% and 62% of the impulse, a specific thing happens within the pullback structure. Price makes a swing low, rallies, and then makes another swing low that is higher than the previous one, a higher low within the correction. This is the first signal. The correction is creating a higher low, which means the counter-trend selling pressure is weakening. Sellers pushed price lower once, then tried again, and could not go as far. Their energy is fading. After this higher low, price rallies again, and this time it breaks above the most recent lower high within the correction. This break is the structural shift. The internal structure of the correction has changed from bearish, lower highs and lower lows, to the beginning of a bullish sequence, a higher low formed, and now a higher high above the corrective structure. The internal structure shift is the first alert. The pattern is close. Element 5, the daily confirmation candle. The internal structure shift has been identified. Now one final element is required before entry is valid. A daily candle must close in a way that definitively confirms the return of trend direction momentum. Specifically, one of the following candle patterns must appear at or near the structural shift level on the daily chart. A hammer, a candle with a small body in the upper portion of the range and a long lower wick. It says, sellers drove price lower during this session, but buyers overwhelmed them completely by the close. Buyers won this battle decisively. A bullish engulfing, a large bullish candle that opens below the previous candle's open and closes above the previous candle's close, completely engulfing it. It says, today's buyers were so powerful that they erased all of yesterday's selling and more. The momentum is shifted. A pin bar, a candle with a tiny body and a long tail in one direction. At the bottom of a correction, a pin bar with a long lower tail says, price was rejected sharply at lower levels. The market tried to go lower, found overwhelming opposition, and snapped back. That level is defended. The confirmation candle is not optional. The structural shift alone is a warning. The confirmation candle is the all clear. Entry without the confirmation candle is anticipation, entering because you expect the pattern to complete rather than because it has completed. Anticipation reduces the probability of success and increases the frequency of false entries. Wait for the close every time. The entry, surgical precision. All 5 elements are present. The trend is established. The impulse has occurred. The correction has developed. The internal structure has shifted. The confirmation candle has closed. Now, and only now, enter. Entry price, the opening price of the candle following the confirmation candle, or a limit order at the close of the confirmation candle itself. Do not enter mid-candle on the confirmation. Wait for the close. If price has moved significantly above your planned entry price by the time the candle closes, evaluate whether the risk-reward ratio still meets your criteria. If it does not, wait for a better entry on the next pullback, even if that means missing this particular instance of the pattern. Stop loss below the lowest point of the confirmation candle, specifically below the tip of the wick if the confirmation is a hammer or pin bar. This placement is structurally logical. If price returns below the confirmation candle's low, the signal is invalidated. The buyers who defended that level on the confirmation candle have been overwhelmed. The structural shift has failed to hold. Exit immediately. Not give it more room. Not wait for a close below. The moment price trades below the confirmation candle's low, exit. Take profit, the previous impulse high, the high that was established before the correction began. This is the minimum target. In strong, well-established trends, price frequently exceeds the previous impulse high and continues to the next structural level. If the trend momentum is strong, if the confirmation candle was large and decisive, if the structural shift was clean and unambiguous, consider holding for the next structural level rather than closing at the minimum target. Position size 1% of account at risk, calculated precisely. Not estimated, calculated. Why the pattern never fails, the forensic explanation. Now the prosecution rests its case. Here is the complete forensic explanation of why this pattern's reliability is structural rather than coincidental. The mechanism, 3 forces arriving simultaneously. When the internal structure shift occurs within the correction, when the higher low forms and price breaks above the corrective lower high, 3 distinct forces arrive at the same price level at the same moment. Force 1, the institutional continuation. Institutional participants who drove the initial impulse have been waiting for the correction. They were not fully positioned during the impulse. The speed and momentum of institutional buying during the impulse prevents complete position building. The correction provides the lower prices they need to complete their accumulation. By the time the structural shift occurs, by the time the correction has retraced a significant percentage of the impulse, the institution has completed its accumulation. It is now positioned and ready to drive the next impulse. The structural shift is often the visible signature of this accumulation being complete. Force 2. The trapped short exits. During the correction, traders who interpreted the pullback as a reversal entered short positions. They are now sitting in losing trades as the structural shift occurs. Their stop losses are placed above the corrective lower highs, exactly at the level the structural shift breaks. When the structural shift occurs, these stop losses are triggered. Short covering orders, which are buy orders, flood the market at the exact level of the structural shift, adding buying pressure to the institutional continuation force. Force 3. The breakout buyers. A third group of market participants, traders specifically watching for trend continuation setups, recognize the structural shift as a break of the corrective structure. Their entry orders activate at the break level. Three forces, three independent sources of buying pressure, all arriving at the same price at the same moment. This convergence of forces is not a coincidence. It is the structural consequence of how markets are organized. Buyers, sellers, stop losses, and entry orders all clustering at the same price levels for independent but predictable reasons. When three forces of buying arrive simultaneously, price moves higher. Not because of technical analysis mysticism. Because of the basic arithmetic of orders, more buyers than sellers at a price level means price must rise to find sellers willing to transact. This is why the pattern works. This is why it has never failed me. Not because I am an exceptional trader, because the convergence of these three forces, given the structural conditions the pattern requires, is as close to mechanically inevitable as anything in financial markets can be. The pattern across different markets. Universal application. One of the most powerful pieces of forensic evidence for this pattern's reliability is its performance across different markets, different time frames, and different instruments. In equity markets, the trend continuation pullback reversal appears on daily stock charts with remarkable regularity. Every sustained bull market trend, in individual stocks and in the broad indices, is composed of a series of impulses and corrections. Each correction, when it ends with the structural shift that this pattern identifies. The institutional accumulation during corrections and the convergence of forces at the structural shift operates identically in equity markets as in currency markets. In foreign exchange, the daily charts of major currency pairs display this pattern constantly. The EUR-USD, GBP-USD, and USD-JPY, the most liquid pairs in the world, produce clean instances of this pattern multiple times per month when in established trends. The deep liquidity of these markets means that the institutional forces driving the pattern are particularly powerful, and the pattern's visual presentation is particularly clean. In commodities, gold and crude oil, two of the most widely traded commodities, display this pattern with exceptional clarity during their periodic trending phases. The weekly uptrends and downtrends in these markets tend to be sustained and powerful, producing large impulses, clean corrections, and clear structural shifts that provide high-quality instances of the pattern with excellent risk-reward ratios. The universality of the pattern across markets is itself forensic evidence. A pattern that works because of a specific quirk of one market's microstructure would be market-specific. A pattern that works across all liquid markets works because it describes something fundamental about how all liquid markets operate. The universal mechanics of buyer and seller interaction that are the same whether the instrument is a currency pair, a commodity, or a stock. The cases where the pattern appears, but should not be traded. Forensic investigation also requires documentation of the pattern's limitations. The conditions under which the visual presentation is similar, but the structural requirements are not met, and the pattern should not be traded. False case 1, the counter-trend appearance. The pattern can appear to form in the opposite direction of the weekly trend. A daily uptrend pullback reversal within a weekly downtrend looks identical to a genuine pattern. The same structural elements, the same confirmation candle, the same internal shift. But it is not genuine. The weekly trend represents forces larger and more powerful than the daily setup. Counter-trend trades, no matter how clean the pattern, face institutional resistance that will eventually overwhelm the setup. Never trade this pattern against the weekly trend. The visual presentation may be identical. The structural support is not. False case 2, the range continuation. In a sideways ranging market, price creates what appear to be impulses and corrections, but they are actually oscillations between range extremes. The structural shift within these apparent corrections is not the return of trend momentum. It is the market bouncing off range support or resistance. Without a genuine established trend, without the multi-swing point daily structure described in element 1, what appears to be the pattern is actually a range trading signal. These trades have significantly lower probability than genuine trend continuation setups. Do not trade the pattern in ranging markets. False case 3, the exhausted trend. In a trend that has been running for an extended period, particularly one that has made several consecutive impulses without meaningful corrections, the corrective pullback that follows may not be the preparation for another impulse. It may be the beginning of a trend reversal. The forensic test for trend exhaustion: has the most recent correction broken below the previous high or low on a daily closing basis? If yes, the structural integrity of the trend is compromised. Stand aside regardless of how clean the subsequent formation looks. Building the evidence file, your personal pattern journal. The forensic investigator does not rely on memory. They document everything, every case, every instance, every piece of evidence. You should do the same. Create a pattern journal, a dedicated record of every instance of this pattern you identify, whether you trade it or not. For each instance, document the instrument and the date, the weekly trend direction at the time, the impulse length and velocity, the correction depth and duration, the internal structure shift, specifically where the higher low formed and where the lower high break occurred, the confirmation candle type and its characteristics, the entry price, stop loss, and target, the outcome, and, critically, whether all 5 elements were present when the trade was taken. This documentation serves multiple purposes. It builds your pattern recognition. The more instances you document, the faster and more accurately you will identify the pattern in real time. It provides your own forensic evidence of the pattern's reliability, a growing database of cases that supports the claim with your own documented experience. And it creates accountability, a record that distinguishes between genuine pattern trades and entries you took that you labeled as the pattern, but that did not fully meet all 5 requirements. The journal is not optional. It is the difference between believing the pattern works and knowing it does. Conclusion: the evidence is in. The forensic case is complete. The pattern has been described with precision. 5 elements, each defined specifically, each requiring unambiguous satisfaction before the pattern is valid. The mechanism has been explained. The 3 forces that converge at the structural shift, creating the buying pressure that drives the continuation move. The universality has been demonstrated. The same mechanics operating across equity markets, foreign exchange, and commodities. The limitations have been documented. The conditions under which the visual presentation appears, but the structural requirements are not met. The evidence is in. This pattern works because of what it represents, not because of what it looks like. It represents a specific, structurally defined moment in the relationship between buyers and sellers. The moment when 3 independent forces of buying converge at the same price, at the same time, for different but predictable reasons. That convergence produces price movement in the direction of the trend. Every time. Not because of magic, not because of technical analysis mysticism. Because of the arithmetic of orders, more buyers than sellers at a price level means price moves higher. The court finds in favor of the pattern. The verdict is reliable. Trade it accordingly.